Hello and welcome to another video of learning Forex together. In this part, I will discuss important metrics in our trading account. First, we start with the balance, which is simply the amount of money in our account. Next is unrealized profit and loss. This number shows the current profit or loss based on our active trades. For example, we have a balance of $1,000 and we open a trade and market moves in our favor and our profit reach $100. So this profit is unrealized or float until we close the trade. If we close the trade, the profit is added to our balance. The next metric is used margin. From our video about margin, we understand that we have to deposit a percentage of our traded base currency to open a position. For instance, if our position size is $10,000, we have to put aside $100 to open the trade. The next metric is account equity. It is simply the sum of our account balance and unrealized profit or loss. In our previous example, if the market move causes a floating loss of $200, our account equity would decrease to $800. Once we close the trade, the balance will reflect the loss and equal to equity, which would be 800. Now it's time to talk about free margin. If we subtract the used margin from our equity, we have the amount that we can use to open new trades. Let's consider an example. We open a $1,000 account. Since we don't have any active positions, our equity is equal to our balance. And our free margin is $1,000. We open two trades. We go short and sell 1,000 pounds at an exchange rate of $1.3 per pound. We go long and buy $10,000 at the exchange rate of 0.9 Swiss francs per dollar. The required margin is 5% for each trade. Let's calculate the required margin. For our first trade, the margin is 65 and for the second is $500. So the used margin is $565. Without any profit or loss, the equity remains the same and free margin is equal to equity minus used margin, which is $435. Another term we can use to describe our available funds to open a new trade is the margin level, which measures the ratio of equity to the used margin. If our used margin matches our equity, we have a 100% margin level, which indicates that we have used all our equity as the used margin, and we can't open any new positions. Brokers set a margin call when the margin level falls below a threshold, usually 100%, indicating that our equity is equal or below used margin. If the market continues to move against us, the margin level will fall below another threshold, for example 20%, at this point the broker will automatically close our positions. This level is known as the stop out level. For the previous example, let's assume that the margin call is at 100% and the stop out level is at 50%. Let's calculate the margin level without any profit or loss. So the margin level is 177%. Later, the exchange rate of pound to the dollar increases 1000 pips, and the exchange rate of the franc to the dollar decreases by 500 pips. Since in both scenarios the market moves against us, let's calculate the unrealized loss using the p-value. For the first trade, we have a $100 loss. For the second trade, the loss would be $588.24. The unrealized loss is then $688.24. Equity, which is the account balance minus the floating loss, is $311.76. Since in our first trade we are trading pounds and it gained strength against dollar, the position value in dollars will also change. And since our account is dominated in USD, first we should recalculate the used margin. And since the second trade, our position size is in dollars, which is our base currency, the margin is constant regardless of change in exchange rate. So the free margin is minus $258.24, and the margin level is 54.7%. So we are below the margin call, which is at 100%. So we should be cautious, and if the margin level drops another 5%, the stop out level is reached and the broker closes the trade. Let's assume our margin level reaches below 50%. So the broker closes the trade. The unrealized loss will be realized and impact the balance. Used margin becomes zero and free margin is equal to account balance or equity. So the stop out level and margin call level are thresholds that brokers enforce to manage risk exposure in trading accounts, ensuring positions are closed to prevent further losses when equity falls below a specified percentage. To sum it up, I bring the key metrics and give a quick definition. For the future video, I'm going to implement a function in Python to calculate these metrics. Thank you for watching.